Thank you, everyone, for reading through those disclosures, and welcome to another one of Avant-Garde Trading's free educational trading webinars. We are thrilled to welcome guest presenter Jeffrey Beamer here this afternoon. He is here to talk with you all about earnings edge, mastering breakouts. Jeff, are you with us?
I am. Good afternoon.
Good afternoon. Thank you again so much for taking the time not only to create your presentation, but to join us here live and present to our audience. We really do appreciate it.
Yes, happy to be here. Thank you.
Wonderful. So whenever you're ready, you can feel free to share your screen and pull up your presentation. And while you're doing that, I'll just remind everyone with us live, if you have questions during Jeffrey's presentation, please type those questions into the chat box or the Q&A, and I will get those to Jeffrey to address at the end of his presentation, time permitting. Let's see. Yep, I can see your screen, Jeff. Looks good. So whenever you're ready, feel free to begin.
Okay, great. Well, good afternoon, everybody. We are at the tail end right now of the Q2 earnings calendar, and we just have a few stocks that are declaring earnings this week. It's kind of quiet. That's why you're probably not hearing much on financial news right now. But let's, before we begin, let me throw up my little disclaimer that we need to do before we start each and every seminar. And if you like and you want to go back and pause this when you watch the replay, if it's available, then you can do so. But that's for the legal purposes. And so with that said, then let me jump into our presentation. This is about a strategy, a simple strategy, and a system, trading system that I'll show you. Okay, just easy peasy stuff tonight. So let's get into it. So a little bit, oops, sorry, my finger hit the little button. What we're going to cover here this afternoon is an overview of the strategy. Okay, we're going to talk about straddles and a little bit about strangles during this presentation. We'll talk about how to find upcoming earnings. Now, this is the catalyst that we're going to use for this strategy. All right. I'll give you a little history that I've learned along the years about why we focus on earnings. We'll identify some behavior patterns within stocks themselves. We'll talk about one of the Greeks that impacts our trade, and that is time value or implied volatility and time. Okay, and then we will talk about some example trades towards the end to give you a little idea of how this works. Okay, so as we begin, let me tell you a little bit about myself. My name, once again, is Jeffrey Beamer. I've been a professional money manager for a couple of decades now. I've been in the industry, well, since I was 19 years old, actually. Got 3 security licenses before I was 20. And then over the years, I have worked for big investment firms, and then I have been the founder and general partner of a couple of my own. All right, I've been very active in the industry. I served on the executive board of the Security Traders Association of Texas for, oh boy, about 15 years. I served as president for 2 years. During that time, and I have been a member of other organizations, including the Market Technicians Association. I was actually the chairperson for the Texas chapter of that group, and then also a member of the National Association of Active Investment Managers. So various industry groups. I'm still part of the Security Traders Association of Texas, and all the good work that they do. So let's jump into it. So that's why I'm here today. I've got a lot of experience, and I've done a lot of research around many of the strategies that we talk about and teach. And so let's get into it. Let's talk about the strategy and capturing the earnings of related price moves. All right. So setting up these trades. Now, straddles and strangles, it's important to note, this is a popular strategy for many option traders. However, this is a strategy that you really learn early on in your education because it's very simple. You buy call, you buy put, same strike, same expiration date, and you go from there. Okay. But all of a sudden, traders kind of learn that this isn't the right strategy for every single stock out there because you need the underlying stock or ETF or security to move. Okay. It just can't sit still. And this is where a lot of traders get a little frustrated because, maybe they pick the wrong stock or they pick the wrong time frame or whatever. And so I'm going to just summarize some years of experience with this and a little history about how this all came about, to make it really concise and simple for you. All right. So we're going to learn how to profit on a stock without having to pick a direction. The stock can go up or down through that earnings event, and we have the potential of profiting from that. Okay. So so I call this a delta neutral breakout. So if you don't know, straddles and strangles are called a delta neutral strategy. Okay. Essentially, the positive deltas of calls cancel out the negative deltas of the puts, and that's why they call it delta neutral. And we are looking for a breakout in this little strategy when the stock moves around earnings. So this is a strategy to capitalize on stock volatility around earnings, to profit regardless of whether the stock goes up or down. So the target stocks are those that are volatile around earnings, because some stocks are not. Okay. We'll learn to profit from breakout moves and IV rush. Okay. So there's two ways to profit here. And a lot of people don't know about the second part of this, that IV rush part. Okay. But I'll show you some examples. So we can profit from two different ways. Either the stock breaks out after earnings, or the IV rushes into the options before the earnings event, because there's lots of anticipation being built up, and that's called IV rush, and we can actually profit that way. Okay. The strategies, as I mentioned, are very simple. They're straddles and they're strangles. Okay. And finally, let's get into building the strategy. All right. So, as we construct a straddle, if you don't know, most people do by now. If you're trading options and you've begun your options education, you simply buy a call and you buy a put. It's done at the same strike price with the same expiration date. That is the straddle. Now, we're not going to touch on strangles too much, but the only difference between the straddle and the strangle is the strangle is done by buying a call, buying a put, but it's done at different strike prices, but the same expiration. That's the only difference. You just widen that out a little bit. So this is a good strategy, both of these. If you think the stock will experience a large price movement in the near future, but are unsure of direction. Now, this is kind of what I was referring to a few moments ago about a new trader that comes in and says, oh, great, I'm just going to throw this on whatever stock they're looking at, and the stock really doesn't have any upcoming announcements or earnings or catalysts to get it to move. The normal buying and selling of stocks on an average day, a lot of times, are not enough to make this strategy profitable, especially when you're not paying attention to some of the Greeks, or you've gone too short in time on your expiration cycle. There's a few things that kind of go wrong. So what we want to do is we want to throw in something that the stock is going to react to. And by golly, that happens to be an earnings announcement. And they happen, for most stocks, they happen 4 times a year. Okay, like clockwork. All right. So this week alone, like I said, we're on the backside of Q2. We have 111 stocks that are declaring earnings this week. And believe it or not, I'm only focused on, I think it was 11 of them out of that 111. It's 10 or 11 because of their either movement or their lack of movement. That's why they've caught my attention. And that's kind of what I'm focused on this week as an example. All right. Now, let me introduce you to option modeling for a moment, okay? So like many people, I am much more visual when it comes to a lot of things, and trading is one of those things where I need to see kind of what's called my risk graph or my risk curve to see where my risk is, to understand what I need the underlying stock to do. So if you've never seen option modeling before, in its simplest form, you have you have a graph like this. Let's say you have a stock trading at $50 and you buy the stock. Okay, this is the risk graph of long stock. Okay, if the stock goes up, you make some money. If the stock goes down, you lose money. Okay, the green and the red. Very, very simple. A lot of people don't know that you can model stock, but you can. Okay, and it looks like this: unlimited reward to the upside and unlimited risk to the downside, down to zero. Okay, unless you're in crude oil, and we went below zero a few years ago, but that's a different story. Okay, so let's get into what happens when we start throwing options in here. Okay, so when you are bullish on a stock, a lot of people will buy a call. Okay, that gives you the right but not the obligation to buy a stock at a certain strike price by a certain time in the future. All right, and that comes with an option premium. Okay, and you'll see that little $2 over there on the left. All right, so what happens is we can buy that 50 strike call, and if the stock goes up, we begin to make money, but we need it to go above $52. So our strike price plus our debit before we start making a profit. Okay. Now if we think the stock is going to go down, we can buy a long put, and that gives us the right, but not the obligation to sell the stock by a certain strike price by a certain date in the future. And very similar here, it has a premium associated to it. And believe it or not, you can combine these two activities together to create a straddle. Okay, when you do them at the same time on the same stock, okay, at the same strike price with the same expiration date, you have a straddle. Okay, now if the call has a debit of $2 as an example, and the put has a debit of $2 as an example, then you combine those together and you get your $4 debit. Okay, and that is your risk graph of the straddle. All right, now what we like to do is we can build these very easily in most brokers' platforms. Okay, you have an option table that can or sometimes does look very similar to this. Okay, and you have your strike price down the middle, you have your calls on your left and your puts on the right. And when you go into your broker's platform, you can see, say, the $50 strike is selling it at $2. You'll notice the column of delta. Sometimes these are interchangeable, and you can move delta over here next to price, and that has a delta of 50 approximately. Sometimes it's right at 50, sometimes it's 49 or 48, sometimes it's 51, 52, somewhere around there for an at the money option. And then also you go to the put side and you'll notice the same price and the negative delta. You combine these together and you get that straddle. Now, some brokers' platforms allow you to select a strategy. And if you select the straddle strategy, you will have the at the money, of course, appear probably down towards the middle or right at the strike price. And you can see here that the debit would be $4, and notice the delta is 0. Now, one important note here is the delta doesn't always have to be perfectly at 0. You know, somebody might build a straddle and go, "Oh my gosh, my delta has a 0.05 or a 0.28. You know, did I do something wrong?" No, it's just that's your delta. You need the stock to actually go down slightly to have a 0, but it's not a big deal. You'll make you have the potential to make money probably quicker to the upside than the downside, meaning the stock doesn't have to move. It has to move farther going down than it does up if you have positive deltas, and the reverse is true if you have negative deltas. Okay, just one of those things. So this is how you see it on your broker's platform, on most brokers' platforms. Okay, so let's begin to look at the strategy in action. Okay, now we gave this example of building the straddle using a risk graph. All right. And what we do is, you know, we talked about break even a moment ago, but let me reinforce this. So you'll notice here where the point of the straddle is, the point where the yellow is, it drops down to $4 on this. All right. So you have 2 break evens on this strategy. Okay. You have an upper break even and you have a lower break even. So how you calculate this is very simple. Okay. You take your strike price, which in this case, the straddle is at 50, plus your debit for your upside break even, that would be $54, and minus your debit for your lower break even, and that would make it $46. Okay. So we would need this underlying stock to move either above $54 or below $46 around earnings to get the profit out of the trade. Now, I'll touch on it right here, and I'll touch on it a couple more times. What if the stock doesn't move? Well, there's a couple of things, okay, depending on your time to expiration, how much time you have in it. Oftentimes, the losses are not the full amount because the stock moved a little bit, but it didn't move its full amount. Let's say the stock moved up to 52, didn't get, it's not profitable, but we are not going to lose our entire debit because the calls are now $2 in the money. They have real value. They will now, you could then sell that for at least $2, if not $2 plus time value. Okay. So that offsets your $4 debit a little bit. Okay. That's the worst case scenario in this type of thing. Well, the absolute worst thing is that you do nothing, the stock doesn't move a bit, and you lose $400 at expiration. Okay, at expiration. It's very rare that we hold these to expiration, or, well, that I would suggest holding these to expiration. Very rare that we would that you would do that, but it happens. I've heard it happening to traders that just kind of forgot about it, or they didn't, react to a movement, or what have you. Okay, so that is how you look at this. Now, what we do with this is we want this stock to move beyond those break evens. That is where the profit lies, and sometimes this profit can be very nice. Okay, and what we want to do then is, I don't know if you kind of saw that, but we will take this and flip it on its side. Okay, rotate it up 90 degrees, and then combine it with a chart. Okay, and so we'll put the chart in. So this is how we kind of overlay the model, the option model, over a stock chart, because then we can see the movement of the stock around in relation to our strategy. Okay, so one suggestion is, and it's kind of shown in this example here, you have your earnings announcement. You want to make sure that your expiration of your options is after the earnings event. Okay, after the earnings event, because that is going to be your catalyst for a move. Now, let's talk about this catalyst for just a moment. I don't know if there's a perfect place to put this, but biotech stocks, the catalyst for them is not only earnings, but also maybe FDA announcements. Maybe they have pending announcement. Maybe they have pending litigation. If you can obtain that type of public information, then that might be some catalyst. It doesn't always have to be earnings. Okay. Or if there's one thing that I would avoid is mergers, because well, just those are, now the merger rumors are one thing, but after the merger is announced, definitely not a place to put a straddle or a strangle. Okay. But anyway, those are some of the things. So there are some other catalysts. That's the point to this this commentary right now, but earnings are the ones we're focused on because those give consistent movement in the stock. Okay. So then we lay out the upper break even and the lower break even. Now, I mentioned earlier about the two ways to make money on the straddle or strangle. One is going into the earnings event with IV rush. Okay. So the stock and or the IV rush could, let's say, move significantly before the earnings announcement. Yes, you can take this trade off before earnings. You do not have to stay through earnings. Okay. And we can profit that way. Now, the profits are often really, I would say between the 10 and 20% range a majority of the time. Any trade that we've taken off prior to the earnings event is usually in the 10% return on risk number or up to 20% return on risk number. It's usually in those double digit range. But then the pro of doing that is that you're not then focused on the earnings event and you don't have that risk through the earnings announcement. But then, of course, the other way is in when we expect a big pop, or drop, and we do get it, okay, and the stock gaps up or gaps down, and we make our money very quickly in those at those times, okay. So as we go, let's talk about a 3-step method to finding these explosive stocks. Okay. Yeah, just 3 steps. It's pretty easy. Now, the history behind this was after hearing, so I was on a lecture circuit for many, many years, teaching people how to, trade these strategies. And one of the things that I was hearing, boy, in the late 1990s, believe it or not, around tech stocks, um, a lot of people were learning about straddles and strangles. And I was getting this feedback that, man, just this is a hard strategy. And it's really not. Okay. You saw that it's just built with calls and puts. And guess what? There's no margin required. It's just calls and puts. There's no selling of options to create a spread. Okay. It's one of the most basic fundamental option strategies there are, straddles and strangles. Simply buy call, buy put, same strike or different strike, same expiration date. Very simple. But as I was getting feedback, what I did was I had a couple of my traders do some research for me and really research into some catalysts that would cause a stock to move. And the consistent one became earnings. Well, not only that, that was actually the simple part. Okay. The more complex part was what stocks typically do it on a consistent basis. Okay. And that is kind of what we're going to talk about right here. Okay. So, step one, and this is pretty simple. All you need to do is find a list of stocks that have upcoming earnings announcements. Now, this is very easy to find these days. Thank you, Internet. Okay. You can simply Google it. You can go to Yahoo. You can go to CNBC. You can go to CNBC. You can go to many different websites, broker platforms, charting platforms, and you can see upcoming earnings. Now, I use a professional tool, and you'll see some of these risk graphs in a moment, called Tom's Option Tools. We're not here to talk about that necessarily, but I just wanted to throw that out there, that that is a tool of option modeling that I use. But you do not need to use a professional modeling service, because you kind of know it's very easy. This is one of the simplest strategies to calculate your risk and your break evens. Okay. And I gave it to you a couple of times. It's your strike price. Well, the debit in your trade, plus your debit to the upside and minus your debit to the downside. Okay. Around your strike price. All right. Pretty simple there. So, next we'll have to identify behavior patterns. Okay. So what we need to do is find some stocks that exhibit consistent behavior around earnings announcements. Okay. Some stocks may be actually pretty quiet going into or out of earnings, while others can be extremely volatile leading into or immediately after the earnings announcements. Okay. And you might be surprised at some of these stocks and who they are. So what we're looking for are stocks that have exhibited regular volatility or explosive movements in and around the earnings announcement. Okay. So let's take a look at Dentsply. The symbol is X-ray. All right. And what I've done here on this chart is I've overlaid the earnings announcements on it. That's with the vertical blue lines that you see. Okay. And so let's circle these. So for, boy, a year and a half, the stock was stuck in a $15 trading range. At times it was even a little less than that. But you start here on the far left. There's the earnings announcement. You can see the stock, which it was a $35 stock at the time. It moved up just a little bit around the earnings announcement, not very much. Second earnings announcement, not much movement, maybe a couple of percentage points. All right, third earnings announcement. This is probably the biggest one here. The stock went from roughly $35 to $37.50. Okay, $2.50 on a $35 stock is actually a decent percentage move. All right, but would that have been profitable? I'm not sure. It depends on where the market has priced the options, where the volatility is, but there's ways to calculate that, and that's what we're going to talk about here in just a few moments. All right. Okay, and so here you have more quiet movement and more quiet movement. So really on this chart, if I was just looking at with the naked eye, I would think this by doing a breakout strategy, I might have made money one time on this, might have, and that's that March breakout there that it went up $2.50. But that actually if I were to put a straddle or strangle on this, there's a good chance I would not have made money. Okay. And so this is not a good stock. Now, what does a good stock look like? All right. Well, let's take a look at PayPal. Okay. This is a great stock to look at. All right. When it comes in and around earnings. All right. This stock will explode. It does move around. As you can see in the time image captured here, the stock had traded in a $45 range, and just around the earnings events, we get these wild swings. Even after the earnings announcement, you can see here on this second earnings announcement, we got the announcement, the stock gapped down, and then all of a sudden exploded back higher. And within the next week, it traded way higher. I mean, it went from about $68 up to looks like almost $90 in a week. Okay, that's a move. That's a mover, and that is the type of stock that we like really trading around earnings. Oops, and I'll go back so you can kind of study that last move there. As you can see, the gap down after earnings, the stock went from just approximately 75, gap down about $11 to $64, and then the next day, the day following, okay, it went from 65 to around 63, and then traded as low as $58 there about 2 weeks later. Okay, so a nice big move. If you'd straddled it at 75 and you just held on to it for 2 days, okay, and then in this example, from the earnings event through the next 2 days, your puts would have, if you'd done a straddle at 75, your puts would have gone, they would be approximately $13 in the money. Okay, now your call would be virtually worthless depending on how much time to expiration you have, but that's offset usually by the profit in the put. And the put has $13 of intrinsic value, of real value, okay, plus time value, depending on how much time you have to expiration. And that is where the profit can be generated. Okay, so PayPal is a great stock that we like to trade. Okay, so now one thing to note is the IV around earnings. Yes, IV does rush. IV does get expensive. And this is where if I jump down to the last bullet there, timing is everything when it comes to this strategy. Okay. And I'm going to tell you why. There's another reason why timing is critical here that we're going to touch on here in just a second. So second bullet point, we'll select options that have already already overinflated IV is a common reason that many traders fail when trying to straddle earnings. Now, I will tell you, we expect implied volatility to be high. Okay. One of the reasons I kind of put this, and I might want to change the name of overinflated, because I'll give you an example. I believe this week it's so tomorrow after the market, I believe it's after market close, I believe. Let me just check here. Cintas, I'll just give you the name. CTAS has their earnings announcement tomorrow before market open. Okay. The IV on those options are actually not very inflated at all. And that's why I was like, kind of staying away from Cintas. Okay, CTAS is the symbol. And also because they don't have weekly options, the next option cycle is in October. They have standardized options. And so, you have 23 days left and till expiration. And, that might be enough time. I don't mind the time. But if you look at the chart on your own, just look up CTAS, you can see that after the earnings event, there might be a little pop, but then the stock moves very, very small. It just doesn't move very much. It moves in gradual, like death of a thousand cuts. It moves up slowly and it moves down slowly, and just one of those stocks. Okay, so the next bullet point: IV crush can eliminate profitability if a stock does break out. Well, yes, we will get volatility crush, but the options go in the money, and I want to stress that in the money options do not get impacted by IV crush because they have intrinsic value. They have real value. Okay, after the move, but the timing is critical. Let's talk about timing just a little bit here in just a moment. Now, so there's two lines here, as you can clearly see. There's a black line. The black line represents implied volatility over 90 days. So these are options that are over 90 days to expiration, and this is the average implied volatility level of those options. Now, the red line is what we look at. Okay, this is the implied volatility average of options that expire in the next 7 to 30 days. And you'll notice here, oops, sorry about that. You'll notice here that there's these spikes, okay? And well, I can tell you, those are the earnings announcements where the implied volatility, we call the upward slope of those spikes, that's the IV rush. And then on the backside of earnings, and it happens in an instant, is what we call IV crush, okay? And that is where the implied volatility just comes out of the options, and the options go from expensive to cheap in a heartbeat. And that is what happens. And look at this, it happens on a regular basis. Okay, this IV spike happens around every earnings announcement. Okay, and then you get the IV crush after the announcement. All right, so this is what implied volatility looks like when you kind of model it out. Now, here's the thing about IV and time. Okay, implied volatility typically rises before earnings, which can make straddles expensive. Implied volatility typically drops right after earnings, which can make straddles lose value. That is especially true if it doesn't move above or below your break evens. Now, earnings moves are often priced into the options, leaving little to no room for profit. So timing of this is critical. And that's what we're going to get into here in a moment. So straddles profit faster when the stock breaks down from implied volatility. Then, okay, my grammar is incorrect here. So straddles profit faster when the stock breaks up or down, okay, than from implied volatility typically moving up. That's how that should read. My apologies. Okay, just trader speak right there. We're not the best at grammar necessarily. Okay, so straddles profit faster when the stock breaks up or down than it does from IV rush. Now, I gave you that example earlier of an IV rush return. It's usually around 10, 15, 20%, somewhere around there, okay, is typical. All right, so let's get into these time frames. What is enough time? So let's review time decay here a moment. This is called theta. So if you're looking at your broker's platform and you see a Greek called theta, that's what we're talking about, time decay here. And it is the dollar representation of how much money you're going to lose every day when you own an option. Okay. Now, option values decay faster the closer they get to expiration, which is true. Theta measures the impact of changing time to expiration. All right, theta loss, or the rate of decay, increases as the options get closer to expiration. All right, so this is where timing comes into play here. We don't want to be in this thing too terribly long, especially after the earnings announcement. Okay, unless we're deep in the money in our options, and then we're okay. Straddles use at the money options, which lose time value more quickly than out of the money options. Okay, so in this example here of this, is your straddles are going to probably have a bigger theta decay value than your strangles are. Your strangles are usually out of the money. So in that example of that 50 strike straddle we looked at a couple times, how a strangle would look is if you bought the 45 puts and bought the 55 calls with the stock trading at 50. Okay, so let me put that another way. If the stock is trading at 50, I could do a strangle where I bought the 55 calls and bought the 45 puts. Now, these options are out of the money, okay, with the stock trading at 50, and time decay will be a little bit less on those since they are out of the money, but we still need to pay attention to what that number looks like, okay? So it's important to understand this, and this relationship is important to the timing of our trades. All right. So here is an example. Now, I told you I was a visual learner, so I'm going to give you some visual. It used to be in our seminars, we would stand up front and we would take a piece of paper, we'd roll it up into a ball like a baseball, and the visual example we would use is throwing that piece of paper across the room. Okay, and so if you imagine throwing a ball, it's kind of level for a while, and then it starts to lose its momentum. Okay, very similar to this pink line that has popped up here on the screen. I mean, so imagine throwing a ball, a baseball, a softball, or a piece of paper that's wadded up like a ball across the room. That is kind of the trajectory that you would get out of that action. Okay, now that is a call or put. Okay, you typically get a little time decay until you get about 45 days in, and then you get a little bit. That's when it starts to really kind of drop, and then you get it within 30 days, and then 15 and 10, and boy, it's really starting to drop at that point. Now, here's the thing. That is if you buy a call or put. Well, what happens when you buy them together? Well, you get a much more steep decline. Okay. That is the trajectory that you get if you were to hold a straddle for, let's say you did a straddle 60 days out. Well, you're gonna lose a chunk between 60 and 30 days, but then you're really gonna lose a chunk between 30 and expiration. Okay. And so that is where we try to time these. Um, is the timing of these is very, very important. All right. So the ideal time frame, as I mentioned, you got your earnings date coming up. You want to you want to put your expiration out there. Now, how far beyond the earnings announcement should you put this? Well, it's a balance, okay? There's no wrong way to do this, okay? You just need to know what the potential outputs or result potentials are. All right, so you can't mess this up. There's no way to mess it up. Doesn't mean you'll always make money, but if you buy a call and you buy a put, and you happen to use, let's say right now you buy November options, but the earnings are next week. Um, the only reason I would do something like that if I was really planning on holding that for that duration, and I was expecting the stock to really start trending either in an up or down movement over that period of time. If I had that type of prognosis, that is the situation. Otherwise, I'm coming in near the earnings event. I don't like coming usually the week of, but I like going a week or two out, maybe 10 to 20 days out. But I don't want to go too far out because then the price goes up. That's the trade-off. You come in. So let's say I have earnings. We mentioned Cintas a minute ago. So if now Cintas doesn't have options that expire this Friday, but if it did, I could buy options that expire this Friday, and the result, the earnings announcement is Wednesday before market open. Those would be the cheapest. Or I could go out a week or two, and I would pay a little bit more, but I have time. And building that time in, I found, is a little bit more valuable than doing it like with an expiration 2 to 3 days away. Can you do a straddle with, only 4 days to expiration? You can, but I would make sure there's an earnings announcement in there and that the stock has historically moved. Okay. That is the only reason I would do something like that. Okay. Otherwise, it would be very reckless for someone to suggest doing a straddle with 4 days to expiration on a stock that just doesn't move very much. Okay. No, that's not, no. We don't do that. Okay. So, this is the example of, where the earnings event is and then how far to go out. Is kind of important. Okay. Now, let's look at some recent trade alerts. Well, I'll tell you what, before we jump into this, I'll tell you right now, KB Home just had their earnings announcement after market close today. Okay. Now, I'll tell you that KB Home typically had an expected move of about 4.6%. And how we know that is by looking at the chart, and we see historical moves in the stock, and we just calculate all those moves, and then we combine that with how the market makers are pricing the options. That's the trickier part. Okay. But with all that math done for you, because I'd already did it for you. Are we okay? Okay. I can tell you that we I already calculated that it was 4.6%. Okay. So here after market, KB Home dropped 6%. So it dropped a little bit more than the expected move. All right. Not much. But it dropped $5.49. It's trading at 81.94 right now after market, and that is a drop of 6.28%. That is a little bit more than expected. Now, would this have been enough to make money in a straddle or strangle? Maybe just a little bit if your pricing was right. Okay. If your pricing was right. And what I mean by right is if after adding up your debit, okay, and you had a move that was 5% out of the money, and that's where you made your money, and the stock moved 6.21%, then you made a little bit of money. Well, at least right now. We'll have to see where the market opens tomorrow, but that is the example. That's a real-time example of a stock that had earnings, and KB Home, KBH is the symbol, and apparently their earnings announcement wasn't too hot because the stock is down 6% after earnings. All right. So let me show you. So I throw, I track I track all, you should always track your trades, and I give my numbers. So that's the numbers you see. Don't worry about that. Okay. Here's an example of Oracle. Okay. And you can see we have an earnings announcement coming up in a few days. And so here I have the stock on the left. I have the risk graph on the right. Now, the black line is the line you should pay attention to because that is at expiration. The other colored lines there, the green, the blue, and the red that you see on the right-hand side of the screen there, those are just timed expiration bands. 1/3 to expiration is, 0 day is today. That's the red line. And then 1/3 is blue. Green is 2/3 to expiration, and then the black. Okay. So here, I have even my upside break even identified, and I have my downside break even identified. My upside break even looks to be around 133. Okay. And the downside break even looks to be around 118 or so. Okay. So I need anything above 133, I'm probably golden, and anything below 113, and I'm probably golden. Okay. Now you can see, look at the last over on the chart on the left-hand side. You can see the stock, the little green emblem there that has an E on it. That's earnings. So you can see the last time this stock had earnings, this stock gapped up about $10 through that earnings event. Okay. So that would be a kind of a nice move. So let's kind of see here. So a straddle was priced at $6.65, so $665. And then we move forward, and you can see here there was a little bit of volatility there. Oh, did I mislabel that chart? my apologies here. Let me go back. Did I mislabel that chart? Okay. This might be, let me confirm this one. Yes, this is Shopify. My bad. All right. So I missed a chart. My bad. But Oracle, same kind of thing. Shopify here. You can see the earnings gap up on Shopify. This is an example of a breakout. The stock was up 17% after earnings announcement, which was more than the expected move, okay, where the option market makers priced the option. And you can see here that the stock, essentially the profit in this, where you take, you can take it anytime during the day. You can see where the stock closed at the end of trading today, but you see that big wick on top. So the entry alert went out that I took was $6.65, and then the exit was $13.80, and that net difference is $715. Okay, that is the profit in the trade. All right. And then here is Oracle. I just misplaced that slide. All right. So here is the Oracle move. Okay. So the entry was $10.25. The exit was $15.56. And the difference there is $551. Okay. So you can, let me go back here a little bit because I want you to see here. Oh, that's a little fuzzy. My apologies. But we have an earnings event coming up in a couple of days. Okay. We're about a week and a half out for expiration. This is an example of a strangle. Okay. Notice the flat bottom of the black line on the risk graph. The flat bottom, that would be a strangle. Okay. And you do a strangle to reduce the price, but the trade-off is your break evens are going to be a little wider. Okay. And you can still, in this example, after the earnings announcement, Oracle closed higher by 11.44%, and that generates a profit of $551 when you add up the approximate debit with the credit at the end of the trade. Okay. This is Restoration Hardware. They changed their name to RH. Okay. Again, another strangle here on this particular trade. Notice the flat bottom of the risk graph. If you look back at the chart, look at this stock move around. This is a $245 stock. So this is going to be a more expensive trade. Let me pause here and talk about the stocks that are trading at $50 versus stocks that are trading at $200. There is going to be a big difference in the debit. Okay. Sometimes stocks trading around $50, your debits can range from around $500 to maybe even $1,000. They're going to be wherever the option market makers are pricing it. I've seen straddles and strangles on stocks trading at $25 that are very inexpensive. They're only $150 or $200. But when you get up to a stock like this, you're going to be paying a couple thousand, maybe around $2,000 debit for that. And that is more appropriate for bigger accounts. Okay. Simply put. Okay. So there is something here for everybody, whether you have a small account or you have a much larger account. A much smaller account wouldn't trade a stock like Eli Lilly or Restoration Hardware or AutoZone, I believe it is. I think I saw AutoZone was trading at $3,000, I think it was. And they had their earnings announcement. Yeah, AutoZone. Can you believe that? That's a $3,000 stock, okay, for AutoZone. And they had earnings, and believe it or not, AutoZone, a $3,000 stock, guess how much that stock closed at today? Up 16 basis points through earnings event. Through their earnings event, the stock closed up 16 basis points. That's 16th cent of 100, okay? Did not move very much at all. But let's get back to RH here in Restoration Hardware. You'll notice we have a flat bottom here. This means it's a strangle. We use two different strike prices, same expiration date. Okay. What we want is the stock to move. And you can see on the chart on the left, there's that little green box. It's kind of hidden up there in the blue lettering, but there's that little green box there that shows the past earnings announcement. Look at that big drop that it had after the last earnings announcement. Okay. So let's kind of see here. Oh, this was a $3,000 debit, $3,100. And then oh my goodness, look at this. This, and believe it or not, this was 2 weeks ago, or what day? We're at the 24th. This was just a little over a week ago, by the way. Okay. This is a current, like a really recent type of trade example. Okay. The stock was up 25%, 25.5%. Okay. On that move. And you can see here where the blue line, which is dissecting price, this horizontal blue line up here that you see are 321, you take that blue line over, and in the risk graph, it stops around the $4,100 mark, okay? And you bring over, it touches the close of the stock, okay? Boom, there is that close right there. The exit came in a little over $7,000. Okay, so your debit was 3,000, your profit or your credit was 7. You subtract your debit from your credit, and you're left with a profit of $3,800 on a stock. All right, so that is on a very short-term trade. Now again, let's go back here and focus on the risk in the trade. Okay, real quick. The risk in the trade, as I mentioned, is you're looking at over $3,000. And if the stock doesn't move, if it stayed right here through the earnings announcement, well, let's just say that's not a good position to be in. Okay. That is why finding these stocks that have exhibited this behavior and normally move big around their earnings announcement are critical. Okay. And this is simply, you can easily go to a chart, and many brokers on their charting platforms and many charting platforms themselves will show the earnings dates, and you can see how the stock moves around and through earnings. Okay. So that was a recent example from a stock that moved just 2 weeks ago. So with that, we are kind of at the end. It's really that simple. So let me summarize here. If you have questions, feel free and type them in. But the goal here again is to find your list of earnings candidates that are coming up. As the next couple of weeks continue on, we will have more and more stocks starting to declare their third quarter results. Okay, as we get into October. As I mentioned, we had 111 this week, so that's actually not very many. There's days that we have 1,800 companies declaring earnings. I mean, there's days like that. Okay. But you find that list, and then you go through that list, you analyze that list, and you look for stocks that historically move big and through earnings. And then you have, and don't think just because a stock is expensive. That's why I gave you the AutoZone example. This is a $3,000 stock that moved 16 basis points through earnings. And then you had a $240 stock move 25% through earnings. Big difference. So don't let the price of the stock fool you. And don't one thing that might help you right now, look at stocks with AI attached to their names. The volatility is really coming out of those. I'll warn you of that. But for a while there, any stock that was related to AI was popping around earnings. I mean, absolutely popping. That is starting to fade, so I will warn you about that. But those are good stocks to look at, and just to kind of give you whatever's kind of in the news or whatever. Those are good places to start. So with that said, this is a way to really make money on a simple strategy, but you got to pick the right stock, and your timing's got to be good. Okay. And with that, Natalie, I will see where we stand with Q&A, if any, and answer any questions.
Sounds great. Thank you so much, Jeff. I'll remind everybody to take note of Jeff's contact information, and feel free to reach out to him if you have any follow-up questions. We are pushing up right against our time frame here, so I am going to start wrapping things up. But I want to thank everyone for taking time out of their schedules to join us today live. Great questions. Thank you for participating. And Jeff, thanks as always for putting together that presentation and really taking the time to talk us through the strategies. We really appreciate it.
You're welcome. Great being
wonderful. Here. And we'll have you back again soon. Thank you again, everybody. We'll see you with the next free trading webinar. And until then, good trading. Be well.